it is important when you interview with an insurance company, understand they do have big differences from other companies. The same thing with banks. You have to get some sense of what are some of the terms you're going to hear with insurance that you're not going to hear with other companies. It was a shock to me my first time out and doing accounting for an insurance company. There's quite a bit of terminology you don't see anywhere else. It's not banks and insurance companies, they have their own unique accounting. There's not much overlap between the two of them either. They're very, very different businesses. So we're talking premium taxes this last time. Premium taxes is the way states make money from insurance companies. They don't really have any other way. Most firms pay a fee for being a firm. I forget the name of it, but insurance companies are exempt from those fees, and they make up for it by paying premium taxes. This was actually a huge issue several years ago, where the state treasurer was suing USAA for not paying their other taxes, and USAA is like, we don't have to, we're an insurance company, we're paying this. It hit the news. It was a really negative thing. USAA ended up winning in the end because that's the deal they had. We're not going to pay our business taxes, we're going to pay premium taxes. And so, but she made it sound like USA was playing the system or something. It's like, no, we're spending millions of dollars in premium taxes. So why do you want us to pay tax again? So there's something called retaliatory tax. So you might see Texas charges its own companies 1%. But for non-Texas companies, they charge them 2%. So if you're domiciled in Texas, you get to pay half as much in premium tax. So Florida charges Florida companies 2%, and non-Florida companies 2.5%. Well, what Texas does is say, okay, if you're going to charge our companies 2.5%, we're going to charge Florida companies 2.5%. To get back at Florida, we're charging Texas companies 2.5%. So it's called retaliatory tax. And what someone discovered, and I can't do the math for you, it's quite complex. But one is people discovered that if a state would reduce its premium tax, they'd actually get more tax. And I can't remember exactly how the math worked, but it was pretty crazy. People went through all the different math, all the different scenarios, and you had to do it state by state and look at it. But there was an optimal level that Texas should charge its companies and other companies in order to maximize its taxes and also benefits its own companies. But it's quite complex. Every state does it to some extent. So you'd have to set up a model that does it 50 different times. But the other issue with premium taxes is there's an offset to premium taxes for certain types of investments. And these are premium tax eligible investments, which means only insurance companies get to take them. And they're usually things like reinvesting in the community, reinvesting in businesses in your state. And if you do those, you get to offset your premium taxes. So USAA, we did a bunch of those. You really can reduce your state taxes by millions and millions of dollars by doing these investments. We did it in Florida, we did it in Texas, and a few other states. So you could justify an entire department just sitting and doing nothing but premium taxes because it's a massive number. USA collects, I don't know, $3-4 billion in premiums. You take 1% of that, you're talking $30-40 million. If you can do a few investments and cut that in half, $15 million, it works pretty well. Some of those investments that we did, very, very low investments, we're making 21-22% returns on with almost no risk. And we're doing a bunch of them, as much as we could do, because my word, that only USA could get that return, because if you weren't an insurance company, you didn't have the premium tax offset it. But part of our return was we didn't have to pay the premium tax. So it's an interesting world. Every state has their own rules, so you really have to do quite a bit of research. All right, something else insurance companies do that no other company has to do with policy acquisition costs. It's a bigger deal for life insurance and property and casualty companies, but this term, policy acquisition, you might think that that means the same thing as underwriting. Underwriting is part of it, but there's more to policy acquisition other than just underwriting the policy. So policy acquisition are all those costs that insurance companies have to get a product sold, get it on the books. For life insurance, it's a lot more involved. They have to do blood tests, medical tests, a lot of other things that are pretty expensive to get a new customer on the books. Property casualty, there's some marketing, there's some upfront policy service stuff they've got to do. There's some underwriting costs they got to do. Second. And what the accountants are saying is the matching principle says you want to match the expenses to the revenue. Well, if you're going to spend a lot of money this year in order to get a customer in the next 10 years, you should spread those costs out over 10 years. And that's what deferred policy acquisition costs are, DPAC. It's only used in accounting. They don't do that in GAAP accounting. They don't do that in statutory accounting. It can be massive. I think when I was at UTSA, their life insurance company, I think it was $100 million asset. It's not immaterial. It's a large asset. It reduces your expenses, but then you depreciate it, you amortize it over time, so it comes back. So what you do is the expenses that you incur to get business on the books, you set it up as an asset and you depreciate it over the life of the policy. You're actually capitalizing an expense. So when you say capitalize, you're taking an expense that would have gone through an income statement. Instead, you set it up as an asset. You're going to depreciate it over time. It can get very, very complicated. This thing called DPAC unlocking might be one of the most complicated accounting things there is in all of accounting. I know you saw some of it in your accounting classes with inventory accounting. It's similar to LIFO unlocking, if you remember LIFO unlocking. But I think it's more complicated than that. It's pretty amazing. I remember we told our CEO about DPAC, and his reaction was, "You do what?" He didn't believe it. He thought that was the craziest thing he ever heard. But it's a huge asset on the books. More for life though. All right, let's talk premiums. Let's see if we can figure this out. So we have earned premiums, we have written premiums. What's the difference between earned premiums and written premiums, and how do they show up on the financial statement? So you just signed the policy. Person just signed and said, "I'm dedicated to this policy for the next year." Well, you don't have any earned premiums at that point because you haven't earned anything, but you have written premiums for the entire year. So the written premiums is your exposure. We talked about this earlier. So you also have premiums that are due. That's like an accounts receivable. That's more life insurance. So your premium is supposed to be paid on the 2nd of the month. That's the due date. Then you have the date when the premium's received. And you could have past due premiums, but in insurance, we don't think about past due premiums because if you don't pay your premium, they can't come after you. You just lose your policy. So it's not really a past due. So there's no collection agencies in life insurance companies because if you don't pay your premium, that's good. It's your choice. You don't have to pay your premium. When a policy becomes effective, the premium is written. Written premiums are saying that you now have 100% of the risk. So whether they have an accident tomorrow, an accident in 6 months, you're signed up. And when we do that premium to surplus ratio, that 3-to-1 ratio we're using, it's actually supposed to use written premiums. I know on the exam question, I'm using earned premiums just because I don't want to mess with your minds on this, but it's actually written premiums, which makes more sense because surplus is how much cushion you have. The written premium is how much risk you're taking, so you want to look at those two ratios. Over time, the risk runs off because the policy is maturing and you're earning the premium. And the earned premium it's just linear. 1 month later, you've earned 1/12. 2 months later, you have 1/6. 3 months later, you have 1/4. So it just goes with the calendar year. So let's try some math. Let's see if y'all can do this. So the policy sold on March 1st becomes effective May 1st, and it's a 12-month policy. On March 31st, nothing happens. because on March 31st, if they have an accident, you don't have to pay them anything. Okay, the policy becomes effective May 1st. All right, so March 1st, no accounting, no written, nothing, no liabilities. As of June 30th, so you wrote the policy on May 1st. As of June 30th, you've got May and June coverage. Your written premium is $120. When did that happen? On May 1st. On May 1st, you have, not May 31st, but on May 1st, the second that policy becomes effective, you have $120 of written premium. Okay. Your written premium is 120. Your unearned premium is 100. Right. So this is very different. Some of you are thinking unearned revenue. Do not think of unearned premium as unearned revenue. You all remember unearned revenue? Someone pays for an apartment 3 months in advance. You got 3 months of unearned revenue. You haven't earned, they paid you in advance. That's not what unearned premium is. Unearned premium is the difference between the written premium and how much you've earned. Right? So you have a written premium of 120. Of that, 100 is not earned yet. So your earned premium is going to equal your written premium minus the change in unearned premium. So your written premium is 120. Your unearned premium is 100 because it was 0. Now it's 100. So your change in unearned premium is 100. So you earn $20 in premium. This is very common for insurance companies that they have to set up accounts because of just the bizarre accounting that companies do. You'll see this a lot in insurance companies where they have an asset that's overstated, so they set up a liability that's overstated, or they have a liability that's overstated, so they set up an asset. They tend to want to balloon up the balance sheets, and that's what you're seeing here. That unearned premium really is not anything. It's a bizarre thing to explain it all. You set up the written premium, now you have this unearned. So it's a bizarre thing. The written premium doesn't go on your financials anywhere, but your unearned does. It's a really, really bizarre thing. Let's go to September 30th. So your written premium is still 120. That's what you did back on May 1st. Your unearned premium now is 70 because you have 7 months left to go. But you've already set up to 120, so you 70 of that you haven't earned yet. So your earned premiums is going to be 120 minus 70 because you started with 0. Now you have 70. 120 minus 70, 50. For the full year, as of 12/31, your written premium is 120. Your unearned is 40 because you still have 4 months to go in the next year. And your unearned premium is 80, which is the 20 minus the 40. But now the next year, you're going to start with 40 and you're going to write a whole new policy. So now you're going to start having to subtract the 40. So it's going to get a little trickier and trickier, but it sets up on the unearned premium exactly what you would expect. So this year you've earned $80 of this premium. Next year you'll earn the remaining $40 and you'll have, you have your correct income statement. That is one major thing missing from this whole thing. What's the one thing you're not noticing anywhere in here? There's no collected premiums. Where's the cash? So they're not even covering the cash at all. Why? Because if you don't pay, you don't have insurance. The whole thing just disappears. So it's really strange. Usually in businesses, you have accounts receivable, then you want to know when did they collect. But here, there's no accounts receivable. There's no revenue receivable. You simply have a written premium and you see how much you earned of it. If they stop paying, you just shut the whole policy down. Very, very different type of accounting. Now, I'll simplify that there are other accounting numbers. We'll see that when we look at the financials. There's other premium related accounting that's just bizarre. It's more on the life insurance side though in here. So the premium to surplus ratio uses written premiums because that's when the risk is accepted. When the policyholder actually pays the premium, this has no impact. Now, obviously, if their premium was due on May 1st and they don't pay it on May 1st, they still have coverage, and there's usually a grace period. So during that grace period, they're going to say, hey, if you don't pay your premium during this period, you lose your coverage, but you paid during the premium, you have it. My mom's life insurance policy had a grace period, and I wanted to keep the policy in force. So I checked with the company and I said, how much do I have to pay to keep this thing in force? I wanted to just pay the bare minimum, keep it in force. But I had that grace period for like 30 days. And then my question to them was, well, what if I pay during a grace period, but then I'm late next month? Do I get a new grace period? And they say, yeah, you get a whole new grace period. So like, why don't I just be late every single month? You know, what do I care? And they're like, yeah, whatever you want to do, guy. They're like, I've got a troublemaker here. So other premium accounts, premium receivable, all these kind of things. Just life insurance has this thing called deferred premiums, which I couldn't explain to you at all today. It's just, and they have loading and negative loading and all these other things. And a lot of it has to do with just the way accounting was set up before computers existed. Some of this really is, we didn't have the computers with all the details. So we set up these accounts and they just never got away with that. They just kept it in place. So, all right, let's talk about a holding company, because we saw that Allstate had a holding company. They asked me to speak to a group of about 50 mid-level managers from China. All these different businesses. They said mid-level management. Usually mid-level management in the US is someone that's managing 10, 20 people. I was talking to these people, they were managing like 10,000, 40,000 people. It's like, wow, that's middle management. They had huge departments. I was talking to them about mergers and acquisitions, which I knew almost nothing about other than textbook. They knew more about it than I did. So it was really a horrible presentation. I was kind of embarrassed to be in there. But I started talking about holding companies. Suddenly they were interested in something I knew something about. So we spent a long time talking about holding companies. They were really intrigued with this whole concept of a holding company. What does that mean? How do you use them? And since I was in the insurance business, I knew a little bit about holding companies. But holding companies is the company that owns everything else. And it tends to be its only business as subsidiaries. It doesn't really have any business of its own. And you'll see it used very heavily in regulated entities. So JP Morgan probably has a holding company. MetLife, any publicly traded, Allstate, they have a holding company, because they do not want the company to actually issue the stock and issues the debt for the company to be in a regulated entity, because regulations are really, really rough. So you tend to have that be a separate stock company. It's the very highest company, usually, not always. Now, UTSA has a holding company. Now, how does UTSA have a holding company? It's kind of interesting. UTSA's main company, the top company, is actually a regulated insurance company, because it has to be, because it's owned by its policyholders. But that company owns a holding company that owns all the other companies. And that's the company that actually goes out and borrows money for UTSA. It's called the UTSA Capital Corporation. And it owns the life insurance company, the bank, the real estate company. I don't know the day what it all owns. In fact, I was an employee of the Capital Corporation for about a few years of my career. They stuck us in there because they didn't know where else to put us. So they actually did have a few employees. Sometimes holding companies have no employees at all. They're just a shell of a company just holding stuff for everything else. And UTSA has a lot of companies that have no employees. They're just there as a shell. So I was kind of showing, this is a good way to avoid a lot of regulation, because it's the holding company that does everything, has all their SEC requirements. They're the ones that have to report to the SEC. They don't have to report to state regulators at all. It saves them a lot of headaches. It gives you much easier access to capital markets, because you're not a regulated entity other than the SEC. And often the only business they have are subsidiaries that they own. And then you can actually have multi-levels of holding companies that own holding companies. So we saw that with State Farm. Let's look at that again, because I think it's kind of interesting. So we saw that earlier, right? A Delaware company. Why Delaware? I haven't looked that up in a while. You can probably Google it. Why do companies go to Delaware to operate? I'm sure 227 million sites will come up. The benefits of incorporating in Delaware. Why do so many companies choose to incorporate benefits? So, you know, it's there. So Allstate, same thing. But here, how can you tell this is a regulated entity? Anybody have a guess how I can tell that's an insurance company? There's one giveaway in the title up there. NAIC, right. And only insurance companies have an NAIC code. So you can tell anyone that has an NAIC code is an insurance company. This is a Lloyd's, it's an insurance company, but it's not a regulated insurance company. So Lloyd's don't have NAIC numbers. There's a Texas Lloyd that does have an NAIC number. Allstate Vehicle and Property Insurance Company. Another Illinois, Castle. Why do they have all these companies? So at USA had, boy, if I can remember, they had the USA company, they had the GIC, the CIC, there's another one. So they had the members in the one company, then they had like the kids and the grandkids of the members in another company, and then they had the enlisted in another company, and they kept putting people in different companies. I think when I left USA, they moved me from the USA company down to the GIC. So I got demoted to the GIC because I wasn't an employee anymore. Why they do that, I don't know. USA is not nearly as complicated as Allstate on the insurance side. They're more complicated on the real estate side. The other thing you'll see is they'll have their life insurance company in here somewhere. Where they help, well, it looks like it's over here. I thought I saw there's a life insurance company there. So they'll have a life insurance subsidiary, or they might have a life insurance holding company that then owns all the life insurance company. It kind of depends. Some firms borrow specifically for their entities. So if you own a bank, you might have a company that only borrows money for the bank. At USA, the capital corporation borrowed for everybody because most of the borrowing was for the bank. So who decides all this? Well, the lawyers decide all this. At USA, they created subsidiaries because of federal law related to hiring principles. So you want to shield yourself from certain government requirements on hiring. So again, lawyer's solution to everything is create a new company. And so you certainly see there, but there's the holding company. That is not an insurance company. It's not a regulated entity. It's an entity. Really just the SEC is the only one out there. All right. So where do you get all this data for all these companies? If you don't have to go company by company. And I highly recommend in your first job, if you don't have this data, go look for it. Oh, SNL bought them. I mean, S&P bought them. So I don't know how to get to it anymore. So let's say any of y'all are working for USA. Intern, are you? All right. Boy, I don't know who to have you call anymore because my contact moved to Victory Capital. But they have this database. Are you doing like an intern?
No, I'll be working for them.
Oh, really? Like an actuary?
Yeah, I'll be personality.
Oh, congratulations. Well, you probably told me that. I forgot. That's wonderful. Yeah, they have this database, and if you get there, and if you have a project where you're curious what other companies are doing, you want to see their Schedule P or whatever, USA pays for this, so you should have access to it for free. My friend can tell you how to do it, but he doesn't work there anymore, so I can't give you, but I think USA still has a library. I don't know for sure. And you could go to them and they would be the ones, but someone would find it. But yeah, ask around. But it used to be SNL, now it's S&P. S&P's buying everybody up. S&P is becoming a pretty good competitor, excuse me, with Bloomberg. So this SNL.com, whatever it is now, but they provide you all of these statutory information in incredible detail, and it's pretty, to me, it's pretty amazing. I actually dumped in over 100,000 securities for all of our competitors. So I could look and see what their duration was, what their credit quality was. So it's pretty amazing. All right, let's talk a little bit about risk-based capital, and then we'll look at Allstate's. So risk-based capital, I think I gave you something. Let's see, I think I gave you something in our notes. Let's see if I did. So here's the actual law itself. Here's an overview document, but here's the actual law itself. So they start off with these definitions. And some of these definitions are pretty comical. But what you'll notice is they have all these different events: company action level event, regulatory action, authorized control level event, mandatory control level event. So the purpose of risk-based capital was speed, give the regulators an opportunity to walk in and start dictating to a company what it had to do. Before, if a regulator said, hey, I'm worried about this company going under, they had to go to the court and get the court to agree that there was a problem, and then they could go act, and that could take months. So what this law says is, hey, if they're below this level, you have the right to step in and dictate to them to have a plan of action to fix the problem, depending on these different levels of action. So it's not that lengthy of a law. It says 26 pages, but it's really not that lengthy of a law. I was in a regulatory type of job when this happened, so this was a big part of my job. I had to read through this, give comments back to regulators. I was also running this against the industry because I had that SNL database. I wanted to see which companies would fail, which ones wouldn't fail. And obviously my number one is make sure USA didn't fail, and USA was well within the scope. So we're like, we're fine with this. But I was curious which companies were failing, by how much were they failing, why were they failing? I had to look at it on the life insurance and the P&C side. This is one law for both companies, essentially, although there are a few differences in the formula. So this isn't the actual formula. The formula is a separate document, but this is the rules and regulations. So this was probably the single most successful thing that the NAIC has done. This is called a model law. A model law means the NAIC, which is a federal group, they write the law and then they try to get the states to adopt it. And this was adopted by the states really fast. This whole thing was written during the time of the SNL crisis, which is interesting because SNL was the name of that group. But the SNL savings and loan crisis, when all these savings and loans and banks were going under and people were worried about the insurance industry. And so the NAIC wrote this law really fast. Actually, the actuaries wrote this law really fast, and then they adopted it. So in the event of a company action event with respect to a domestic insurer, the commissioner should take no regulatory action hereunder. In the event of a regulatory action event, the commissioner should take the actions required under Section 3. So you see, it's given the law says they can do this. They don't have to get a judge to approve this. And it's a formula, so it's not like they're treating one company separately, differently than another company. And so the other thing I gave you here, was a good summary article. It's only 5 pages. So you can certainly, there's the actual formula itself. The life formula is more complicated than the property and casualty. And in fact, this law was really taken charge of by the life insurance actuaries. They sat down and they did the work, and they did some amazing statistical work for this law. And then the P&C actuaries said, yeah, that looks good, let's go with it. So it really wasn't. The reason for that is the life actuaries had a whole lot more data, especially on the investment side, because they're much more involved in investments than the P&C actuaries were. So the P&C actuaries essentially relied on the life insurance side to build this thing. So there's a lot of data going back. All right, so there's some really bizarre stuff in here is related to these different triggering events. Essentially what the law says is you calculate your risk-based capital. You then take 50% of that, and that is your authorized company action level or regulatory action, forget which one. And then you have to have at least 200% of that or they shut you down. So they take RBC, take half of it, and then multiply that by 2. That's how the law is written. My critique to them was, why are you dividing by 2 and then multiplying by 2? That seemed like a roundabout way to do it, but that's what they did. And they said the reason they're doing that is they didn't want people abusing the law and taking these numbers and calculating them and going into the press, but the press immediately did that anyway, so it didn't protect them. But that's why, and it was, I remember reading this and going, wait, what are they saying here? And it got really confusing because the divide by 2 is early in the law and the multiply by 2 is late in the law. And you had to go back and say, wait, did I just read that correctly? Why in the world are they doing it like that? But anyway, so if you want to get into this and read through it, give yourself some, especially if you're interviewing with an insurance company, I'd recommend you read the summary version because it's got everything in it that you need. Make sure to take it with you though, because once you graduate, you won't have access to this anymore. All right, so risk-based capital is essentially asking how much net worth does a firm need. It's much more sophisticated, supposedly, than the 3-to-1 surplus ratio we've been using, that we're using on the exam. Risk-based capital, unlike the 3-to-1 ratio, does take into consideration what kind of business you have. So if you're only doing auto insurance, you don't need as much net worth as if you're doing homeowners, because homeowners is a much riskier business. Whereas the premium to surplus ratio completely ignores that. And they have 4 categories of risk: C1, C2, C3, C4. C1 is asset risk. It's mainly focused on stocks, price risk, and for bonds, credit risk. So C1 risk doesn't focus in on the price risk of bonds. It doesn't worry about interest rates rising and falling and bond prices moving around. It's only worried about default risk. And that's why treasuries get no weight at all. If you own treasuries, you don't have to hold any capital law because there's definitely price risks. We've seen that in the last few weeks, haven't we? Interest rates are up, treasury prices are down. They ignore that entirely. They're only looking at the risk of default. And then stocks, they use a 20% charge there. For subsidiaries, they say if you own a subsidiary, we're not going to count any of that. You got to hold 100% because that subsidiary needs all of its capital, so you can't count any of that capital. So 100% charge there. And then they have a concentration charge. If you have too much loaned out to one entity, they're going to haircut you some on that. That was a really complicated part of the law because you had to go through and look at every security you owned and see if you had any overlap. C2 is the insurance risk. This was a huge one for the property and casualty side. It's a factor applied to premiums or to reserves, depending on the business. The problem they had here is how do you take the probable maximum loss and put it in a formula that you can apply to all companies? And I think they're still struggling with that one. Now, something I did that I thought was pretty cool is I took UTSA's probable maximum loss numbers, knowing that Allstate and State Farm had very similar books of business, and I applied them to their books of business. So I could compare UTSA, those companies. And I even had the head of actuaries thought that was pretty cool. So I thought, wow, that's pretty cool. Someone that smart thinks something that was pretty cool. But just looking at it and saying, here's their business. I adjusted it for their homeowner versus auto and all of that. And their Florida business, I actually broke it down by state because you can do that with this SNL database. And I brought it back up and say, assuming State Farm has similar exposure in the different states, what does their PMO look like versus UTSA's? And yeah, that got good reaction. And then C3 risk really only applies to life insurance companies. So if you take my life insurance class, we talk about the disintermediation risk of life insurance. That doesn't really apply. So most P&C companies don't have any of that. And then C4 is this other, and that really is the risk of a major industry crisis where your company's bailing out the rest of the industry. Here's the way they do the formula, which I really like this formula. I remember I showed this to my boss's boss. He was the corporate treasurer at UTSA. He goes, oh, that's cool. Look what they're doing. I had no clue. It didn't jump out to me. He says, no. They're either assuming everything is perfectly positively correlated or things are uncorrelated. And he got that out of his formula. I said, what do you mean? And he said, okay, if you square something and add it to something else that's squared, and then you take the square root of that, you're assuming the correlation is 1. So the formula takes, I'm sorry, I said that back. So if you add two things, then square them and take the square root. So forget what I just said. If you add two things together, then square them, and then take the square root, you're assuming they're perfectly positively correlated. If you square something and add it to something else that's squared, that's the first thing I said, I just said it backwards. If you do that, then you're assuming they're uncorrelated. All right, let me show you mathematically how this works. Let's say risk A has a risk of 3, risk B has a risk of 5. So if we add these two things together and then square them and then take the square root, what are we going to get? Come on, actuaries, is your thing. You'll get 8, won't you? So what's that correlation assuming? 1 correlation, right? What if we take that and square it, and we take that and square it, and then we take the square root of that? Are we going to get a higher number or a lower number than 8? Well, you know you can't get a higher number. Lower number. It's going to be a little bit lower or a lot lower? Quite a bit lower, right? A good, I don't know what that is. Good 27% lower. We're assuming these two things are uncorrelated, so it's unlikely when you lose the 3, you'll always be also losing the 5. And so when you do that, what do? You get a number that's really close to the bigger risk. That's what makes it. When two things are uncorrelated, you essentially just get the bigger risk. When two things are correlated perfectly, you just add the risks together. And I said, oh, I didn't even see it. He saw that immediately. It's how smart. Well, probably I'm just not that bright, but he's a lot smarter than I am. But yeah, he saw that immediately. He says, okay, they're squaring that, then they're squaring that. So here, these two things are squared and this is squared, and they're adding, taking square root. They're assuming that C1 and C3 are perfectly positively correlated, but C1 and C3 together are uncorrelated to C2. And that makes perfect sense. C1 is asset risk, C3 is interest rate risk. That sounds like two related things, doesn't it? So those two things are perfectly positively correlated, but C2 risk is insurance risk. Well, insurance risk isn't related to asset and interest rate risk, so it makes sense. And then they just add C4 risk on the end. That just means it's perfectly positively correlated to everything else, because if the industry is blowing up, you're probably bailing out the industry. So they just added to the end. So I said, okay, that makes a lot of sense that they're doing that. All right, so let's look at Allstate. The 5 years on page 76. I love the 5-page. In fact, if I were interviewing with a firm, I would start here. The 5-year historical data, you have a lot of data. So let's say you're interviewing with Allstate, get their 5-year historical page, print it out. It's 2 pages of data. You can look at their revenues over time. You can see what businesses they're in. You can see their profitability over time. You can see their reserves. You can see when the reserves jumped. You can see which line the reserves jumped in. There's all kinds of data here. So here you can see liability lines, property lines. The liability lines include both homeowners and auto. Auto has liability, homeowners have liability. Property lines, that's property for auto, property for a homeowner. Although the combined lines might be, I'm not sure exactly, that might be the auto there. I'm not sure exactly how to break that out. But your goal is to look at the growth. So as we said last time, they had tremendous growth. That's pretty amazing. And it looks like it's pretty well spread throughout here, although this right here jumps out at you, doesn't it? So you might go back and look at more detail and see what happened. Why did they go from 96 to 942 million? Those are the kind of questions that someone interviewing for an entry-level job, that's where you blow them away. It's like, I was just curious, why did your outlet lines jump from 0 to whatever? And they're probably not going to know the answer, but they'll be impressed that you knew that. Here's their net income. Their net income jumped from 2019 to 2020. Is that because of COVID? That would certainly be possible, wouldn't it? People stopped driving, they had fewer claims. Their underwriting gain jumped, their investment gain jumped as well because the markets actually did pretty well. Their investment gain jumped a bunch that year. That's really interesting to me, but their underwriting dropped. You're already seeing really, really interesting things here. So it looked like their net income was kind of flat, but they had a lot investment gain, and yet they didn't have a good underwriting year. Why didn't they have a good underwriting year? You know, I can't answer that question. Here's their taxes, their total assets. So here's their risk-based capital. I'm going to see if I can get this into Excel. I don't think I can, but we're going to try anyway. Yeah, not quite. All right, so let me snip it in. I want you to look at this. If I were interviewing with them, I would definitely be doing this calculation. So here's their risk-based capital. Let me just real quickly give you some numbers. 18,431, 2537, 19,569, 17,288, 17,702, 2867. I'm going to ask this on the exam, but you don't have a practice problem part. So make sure you get this in your notes because you're maybe not going to ever see this again. All right, so this is the authorized control level RBC. This is the adjusted capital. Now, adjusted capital, so what does that even mean? So if we go back to their net worth, here's their net worth. You're going to notice that's essentially it's the same number this year, isn't it? 18,431. It's the exact same number. That's really, really strange. The previous year, 2537, 2164. This is the first time I've ever seen where their actual net worth is the same as their adjusted capital. I wonder if that's even a typo. Someone might have typed things wrong. But they're very, very close. 20,167 versus 20,537. So this is essentially their net worth. All right, y'all see that? So what I might ask you on the question is, what is their RBC ratio? All right, remember the authorized control level is RBC divided by 2. The RBC ratio is their authorized, adjusted CAP divided by their RBC. So how do I get the RBC ratio? Any guesses on that? So this number is 1/2 of RBC. RBC is your adjusted capital over your, RBC ratio, adjusted capital over RBC. So just yell out the numbers. Well, your numerator is capital.
So 18.
And what? Divided by that times 2, right? That's going to be their RBC ratio. 321 is about right. Why 300%? Why it's so high? Well, remember, if they get to 100%, the state comes in and takes over their business. So you don't want to be at 110. That's just kind of too close. So 321, 352. And remember, at year end, you don't know exactly what these numbers are. So if you're at 110, there's a good chance plus or minus 20%, you could be in a lot of risk. So their ratio is pretty strong. It's gotten stronger. It got stronger during COVID. Now it's back down to kind of more normal levels, 321. They were a little weak there and 4 years ago. And so at 321, the law doesn't have anything. It's not going to say anything. It really doesn't have any authority until you hit that 100%. At the 100%, they don't necessarily take over. It's as you fall below that. But there are certain reporting management has to do. So, you can read the law and see all the requirements. But 321, I think USAA was kind of in that range as well, maybe a little bit higher. That's not an unusual number to see. Now, remember, Allstate has multiple insurance companies. You saw that big list. Every single one of them has this ratio. So if any one of Allstate's companies falls below 100, that company is going to have to explain itself. Now, what would Allstate do? They probably just dump a little more capital into that company and bring them up to the level. I remember at USA, we had some companies that were like 300-400%. We had some companies like 1,200%. They're just massively overcapitalized because they're really little bitty companies. And so, yeah, I mean, that's the way they're going to look at it. You can look through it over time and see if anything's bouncing around. So here, the big thing that happened here wasn't that their risk went up. The big thing here was that their net worth went up, or that the risk did drop a little bit, but the main thing was their net worth jumped. And then their net worth fell. Well, why did it fall? That's something I want to look at. Their net income was about the same as last year. So there's a good chance they paid dividends. And so we can go look and see, did they pay a big dividend? They paid a pretty good sized dividend. There's something else going on that's causing their net worth to have fallen. Probably you can look through these lines and see, here's something here. Unrealized capital losses. So they had some investment loss. Deferred income tax did something. So there's things going on. You're trying to figure out, just like any other type of financial analysis, is why did their net worth drop 1.5 billion last year? If their dividends had gone up that much, I see it right there. It wasn't. Oh, it is. That is the answer, isn't it? I missed. Their dividends did increase 1.5 billion, and so their net worth fell 1.5 billion. So that makes some sense. I misread the dump number. I thought that was 5.4, but so, I mean, I'm trying to, you're going to really impress them if you have this level of knowledge. So it looks like what happened is 2020 was a great year for them because of COVID. No one was driving, and auto was a big part of their business. And then they decided in 2021 to spend a dividend. Now, USA gave a special policyholder dividend, not stockholder dividend. Especially policyholder dividend would be down here. And you can see they didn't do that. If we had USAA's financials, you would have seen a special, pretty large dividend they pay that year. Allstate doesn't pay dividends to their policyholders for some reason. They're not a reciprocal, they're not a mutual. So if you looked at a reciprocal or mutual, you'd probably see dividends there. But since they're not owned by their policyholders, they don't owe their policyholders any money. So. Right, so you really can learn a lot about these companies by getting into their financials. All right, so let's look through their financials. I want to get you some sense, if you interview with these companies, what you would look for. The first page is where I would start. This is called the Jurat page. This is only about this company. So you need to find the biggest company that they have, the one that has the most net worth, owns all the other ones. So this isn't the holding company. This is just the insurance company. This is an Illinois company. Illinois is known, I think State Farm's in Illinois as well. Illinois is known as Illinois, New Hampshire are the big insurance states. Tells you where their main offices are. One thing I'm going to try to do in the fall, and y'all can watch for this, we were going to do it in 2020, but for some strange reason it got canceled. Something happened in March and April, it got canceled. But I want to have an insurance day. I want to invite insurance companies to come to campus. We'll pay for all this food. You're all graduating, so you may not care, but if you're not graduating, set up a time for you to meet insurance companies, because for some reason, Allstate, State Farm, MetLife, these companies don't come to UTSAs. So what I want to do is bribe them to come to UTSA, present to our students, interview them, have a big day. The Insurance Council of Texas has given us all this money, so I've got money to play with, to have a really, really good a day for that. So y'all watch for that. But Allstate, I want to invite them down. They may not come down from Illinois, but there should be offices here in Texas. They had a huge office at Austin. They used to drive by every day. So, but this is the main office. So if you're an actuary or a finance person, you'd probably be working in this city, wherever it is. I don't know where Northbrook, Illinois is, but that's probably where you'd be working. They give you the contact information. You know, cold call this person. I don't know how much guts you have. They say, hey, Miguel, Mary told me to call you about, you know, that you might have some openings. And hopefully he won't say who's Mary. Maybe he who knows someone named Mary. Or say, Rhonda told me to call you. Mario Riso told me to call you. You know, you could probably get yourself in a lot of trouble doing that. But anyway, they do have a sign off now. They don't have it here. I wish they did, but the chief actuary has a sign off on their reserves. They don't put that in this blank, but I wish they did because I'd really like to read exactly what he or she is signing off on. They do give you the officers of the company. They do give you the board members. So you do get a lot. So read through this. You might find an uncle in here somewhere that could get you a job. So that's the juror page. A lot of good information there. There are very specific rules for that. We had an officer whose first name was M, the letter M without a period. And they kept kicking our statements back to us. They said no abbreviations allowed. And we're like, that is his name. His name is M. He didn't go by M. He went by his second name, but that was his name. Then you get to the balance sheet. So you have assets and liabilities and reserves. On the assets, what you're going to know is we're going to talk about this. But for a property and casualty company, the biggest thing on the asset page is the bonds. Insurance companies buy a lot of bonds, treasuries, corporates, and municipal bonds. The other thing you're going to notice is stocks. Insurance companies buy, and property and casualty companies buy a lot of stocks. Life insurance companies don't buy any stocks. Allstate does have a pretty large stock portfolio. So that's pretty much it for their assets. Corporate bonds, treasury bonds, municipal bonds, and common stocks. There's no other massive number here. Now, Allstate is a little unusual that they have other. And you notice right here, it says Schedule BA. So 10 billion in other, that's pretty unusual. USA has a pretty large other as well. If you go to Schedule BA, Schedule BA, you'll be amazed at what they will have in there. They list in detail. I mean, this is what I love. You can see why I love this attribute links. They list in detail every single other assets Allstate owns. When I was looking at Allstate and trying to figure out their asset allocation, I pulled up their Schedule B and I just said, okay, that's private equity, that's real estate, and I could actually list each one. In fact, for all the companies I looked at, I could, using this information, I could account for over 98% of their assets. I could actually do, there was only one company I couldn't do that for, and that was USA. But USA had insider information, so I could do USA. But if they looked at USA, they could not have done what I did for them, because I could go through in detail all the assets they have. And you can figure out what these things are. You really can. I mean, it says small cap fund, Asian Pacific fund. These are private equity type of funds. And it's pretty amazing. You can tell what the real estate was. Blackstone Group, obviously that's going to be some type of private equity. So they do a lot of private equity. And you can see that right there, but you can even see which ones they're investing with. If you want to go and find their biggest investment and go see what they're doing, you can look at that fund. Now, Allstate probably doesn't want you to know this, but they don't have any choice. It's required by law to put all that detail in there. So it's a really amazing, amazing thing. And I pulled all this information in Excel, and I just went through. In fact, I pulled in every single stock that they owned, and I figured out if it was a U.S. large cap, U.S. small cap, international stock. So, you know, you have all that detail. It is truly, truly remarkable. So one of the favorite presentations I did at USAA was I did an efficient frontier of USA versus all of its competitors. And man, the exec council loved that. I could show them that because of USA's huge tax advantage, we had just as high of an after-tax return of all of our competitors with a much less risky portfolio. It's like, wow, that's pretty cool. We can make the same return with much less risk than our competitors because of the way the IRS taxes you. All right, so you might be interested in that particular line, the other assets, but you see how they do it. They tell you where the detail is. It's in Schedule BA. Mortgage loans, where would you go to figure out the mortgage loans? Schedule B. Where do you go find the bonds? In Schedule D, the stocks. And in the bonds, they show you every single bond that they own. For State Farm, that could be 600, 700 pages. So you got to be careful. You don't want to print it, but it can be massive. I think State Farm actually publishes their Schedule D as an entire separate book because they couldn't put it all together. And so you have that kind of detail. Once you get past all the assets, so you can see the total of the investments is 49 billion. The total assets is 59 billion. So a big chunk of their assets is investments. So what else do they have? Well, a big chunk of the rest of it is their premium. We didn't talk about uncollected premiums and deferred premiums. We're not going to worry about those. Why do they have uncollected? Why do they have deferred? You notice they don't really have accounts receivable because there is no such thing in insurance. But the uncollected premiums, it's those premiums they were supposed to be paid, they haven't been paid, but they're sitting in the unearned premium, they're sitting in written premium, so they have to set up the asset because they got it set up in the liability. It's that bizarre world. So that's 8 billion of the other 10 billion we're missing, and everything else is just kind of normal accounts receivable. They have accounts receivable related to their investments. They had deferred taxes. Now, when I was doing this, there was no such thing as deferred tax on the statutory side, only on the GAAP side. The statutory side decided to set up their own rules for deferred tax. So there's their assets. And what do you think the bulk of their liabilities are? So they have $40 billion in liabilities. That kind of sticks out, doesn't it? 17 billion. That's their reserves for losses. 3 billion, what is that? That's the reserve for loss adjustment expenses. So I have these losses that they haven't paid yet. They have adjusters they haven't paid yet. And then they have 12 billion. What's the 12 billion? You now know what this is, right? It's the unearned premium. It's that written premium that they haven't earned yet. That's 12 billion. You add those three together, 17, 20, 33 billion. 33 billion of their 40 billion in liabilities are the reserves. So what's the rest of it? There's really nothing. Well, they just have normal expense accruals like any company does. Nothing else really stands out. They're doing securities lending. So they have a big payable there, but that's related to the investments. So yeah, so an insurance company is pretty straightforward. It's the assets are bonds, stocks, maybe some other assets, a little bit on the premium receivable kind of side, but that's it, 4 things. And then liabilities is reserves for losses, LAE, your unearned premium reserve, and that's the bulk of your liabilities. It's a pretty easy business. You notice the actuaries dominate the liability side, the investment dominates the asset side. That's it. That's what an insurance company is. Then you get into the statement of income, and as we already saw, for a property casualty insurance company, you have the underwriting up top. So you have your premiums, you have your underwriting losses and expenses, and there's your net income. All right, so we notice here that their underwriting dropped dramatically here. And what you notice is their losses jumped dramatically. Their expenses didn't jump, but their losses. Now, is it possible for their losses to jump dramatically without their LAE jumping dramatically? It'd be pretty unusual for that to happen. If you have larger losses, you're going to have to pay people more to look after those losses. So what happened here? That's something you want to look for. We saw that when we we're looking at this last time. I don't know what happened in 2021 that caused them such large losses. But we could probably go through state by state and see if there's a state that really jumps out. Remember, you have those state pages. It's going to be one of the larger states. So I would look at California. That's why I thought California could be the culprit with all the fires and mudslides, but we didn't really see that. I would look at New York. I would look at Florida. I don't remember any major hurricanes last year. Y'all remember anything last year that was a big event? This doesn't come to mind to me other than the California fires. So it seems like there were fires in California the last 5 years. So I don't know why that was just spent last year. I just don't remember. But I would sure like to know that if I'm going to interview with this firm. The other thing I might do is find a competitor and see if they have the similar type of big jump. So go look at Progressive. Progressive only does autos, so it's probably going to look a lot different. You might look at Amica. I think Amica is only is private, so they may not be able to find the data. But then their investment income jumped dramatically. Why is that? Well, there's an exhibit for that. There's an exhibit for net investment income. We'll look at that next class so we can see what line really jumped there. We can try to figure out what's going on there. They have it under investment income. They don't have it under realized gains. So it's not a realized gain thing going on. So I don't really know what's going on there. I mean, here's their realized gains here. So something strange happened there. You can go down to their exhibit for net income. It's not that one. Not that one. I know it says investment, so it's not that one. Exhibit of investment income. You'd have to take this year's and then pull up last year's and compare them because they don't show you the 2 years here. So you'd have to go figure out if something jumped. But you know what the big line items are. I'm going to guess that it's this one right here. They got $2 billion in common stock of affiliates. So my guess is what happened is a subsidiary paid up a large dividend. That doesn't go as an unrealized a capital gain. That goes as regular income. So that's what I'm guessing. And I want to know which subsidiary paid the large dividend. All right. So you see how you can just forensic finance. You can go find these things. I find it fascinating. If you find this stuff boring, you probably are in the wrong field. This is what finance is all about. You're trying to figure out this company. And this is the kind of thing you're going to do. If you got the job you want to get, this is what you need to do. You need to sit down and go through the company and try to figure it out. All right. So you have underwriting. You have the investment side, and then you have a few other miscellaneous things that are not that big of a deal. And then you have the net income of the company. And then on the capital and surplus side, here's where we can see the big items and see why their net worth dropped. They have some miscellaneous things. I'll look through them and see if there's any really major thing going on, but I don't see anything. Well, this first one, allocated share gain loss on sale of fixed assets. I don't know what that even means, so you'd have to look that up. Cash flow statement, we completely ignore. We don't care about the cash flow statement of the banks and insurance companies. All right, so I'm going to go through a few other exhibits. We're going to skip some of this stuff, but there's some really cool stuff in here I want to do. So we will next time get through some of these other exhibits. So I'm going to show you some of this cool stuff here. So I'm going to let you out a little bit early.